Okay, so we are recording right now, class, ha? So I hope that's fine for everyone, so that the others can see the discussion for chapter 5. So please repeat number 1, please.
Okay, so number one says PAS 8 provides the guidelines what should be disclosed as accounting policies. The answer is false because the description refers to PAS 1, which provides the guidelines what should be disclosed as accounting policies, while PAS 8 provides the guidelines what should be disclosed as changes in accounting policies.
Please take note of this kind of questioning, class, ha, in which concepts pertaining to one standard is being attributed to another standard. So it would still appear true, but what makes it false is that it is being attributed to the wrong standard. So make sure that you can connect the correct concept, the correct rule, the correct principle with the appropriate standard. It does not mean that it appears to be correct, it appears to be a true statement, automatic, it's true already. Make sure that it is attributed to the correct source, to the correct standard.
Number two, accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. The answer is true.
Okay. So there's nothing to add here, class. This is simply the definition for accounting policies. Can you imagine this as a multiple choice question? Yes. You would be given with a definition of accounting policies, and the choices would be accounting policies, accounting estimates, so on and so forth. So the common source of confusion here, class, is that this definition would be misidentified as the definition for accounting estimates. Okay, so please be careful whether the definition pertains to accounting policies or accounting estimates, class. That would be the main source of error. You would be confused whether it's accounting policy or accounting estimate. And as early as now, I want you to make sure that you would be able to identify the distinction now between accounting policies and accounting estimates. Number 3.
If there is no available standard which covers a set of transaction, conditions, or events, the management may use its judgment in developing and applying an accounting policy that produces relevant and reliable information. The answer, sir, is yes.
Okay, this is true. Okay. Uh, what do I want you to take away from number 3, class? The management is allowed to make use of its own judgment, class, but understand that you only go there, you only use your own discretion if no standard applies. What does that mean? If a particular standard is applicable, class, you are not allowed to make your own judgment, you are not allowed to use your own judgment, follow the standard. I hope that's clear to everyone. If there's an applicable standard, follow the standard. When do you use your own judgment? When do you use your own professional judgment? Only when no specific standard is applicable to a certain event or transaction. Very important, class. Follow the standard first. Use your judgment only if no specific provision in a standard is applicable.
Number 4. Changes in accounting policies will be accounted for through retrospective restatement.
What does the book say about about a change in accounting policies, man? Can you read it?
Changes in accounting policies, sir, kay, once an accounting policy is selected, the same must be applied consistently. How should the change be applied? It should be applied in accordance with the transitional provisions of the standard. This is applicable when change is required by an IFRS and such IFRS contains a transitional provision. So we should apply it retrospectively because this is applicable if the entity change an accounting policy voluntarily, sir, or if the IFRS does not contain any transitional provisions.
So that's it.
Yes, sir.
It tells you, class, that you have to apply, you have to use retrospective application, class. But what does number 4 state, class? What does number 4 state? It states that changes in accounting policies shall be accounted for through retrospective restatement. So I want it to be clear, class, that retrospective restatement is different from retrospective application. So number 4, class, is false. Why is number 4 false? because it should not be retrospective restatement, but it should be retrospective application. Class, you would be introduced to 3 treatments, class. You will be introduced to 3 treatments in past 8. The first one is prospective application. Second is retrospective application. And third is your retrospective restatement. And they have different applicability, class. When we say prospective application, when when do we use of prospective application? We use prospective application if we are dealing with changes in accounting estimates. Again, changes in accounting estimates, use prospective application. Changes in accounting policies, use retrospective application. The third one, class, retrospective restatement. When is retrospective restatement applicable?
Prior period error.
That's correct. Okay? Retrospective restatement is applicable only to prior period errors. So, this is how we are going to simplify it, class. You might be still confused with the definition of prospective application, and retrospective restatement. But to simplify it, class, just match them properly, class. Just match them properly. What's the treatment for changes in accounting estimates? Again, prospective application. What's the treatment for changes in accounting policies? Retrospective application. What's the treatment for correction of prior period errors? Retrospective restatement. So please understand that retrospective application is different from retrospective restatement. So at this point, it might not be entirely clear, class, the definition of these three, but at least you are sure if you are asked, what do you do if there's a prior period error? Then your answer should be retrospective restatement. What do you do if there is a change in accounting policy? You would say apply the changes retrospectively because we use retrospective application. What do we do if there is a change in estimate? We apply the change prospectively. So again, very important. Match prospective application, retrospective application, and retrospective restatement to the appropriate transaction. Okay, we'll try to explain later what you are going to do under those 3 treatments. But as of this moment, class, it's very important that you would know when those 3 treatments are applicable. Okay, please proceed.
An example of a change in accounting policy is an application of a new accounting policy for transactions, other events, or conditions that differ in substance from those previously occurring. Our answer, sir, is false because like differs in substance, meaning it is not a change in accounting policy but an initial use of the accounting policy, sir.
Okay, so number 7, class, is an example, is one of the 2 examples given in the standard which we are not to consider as a change in accounting policy. But I hope when you read that portion of the standard, class, you were able to tell yourselves that it makes sense that why they are considered to be not changes in accounting policy, because basically it's not a change because it's the first time it is being applied. It's the first time it is being encountered. It's the first time that we are treating such transaction. Okay, but it does not matter if we find the particular provision in the standard useless. But what's important is you understand why it is not considered a change in accounting policy. Again, there are 2 examples given in the standard, class, and both of them are very understandable, class. They are not changed because basically it's the first time you are dealing with those kind of transactions. Cannot be called a change if it's the first time you are dealing with such kind of transaction.